Hello everyone and welcome to today's Mondac webinar in association with Savva and Associates. Our expert speaker will provide an in-depth exploration of how cryptocurrency investors, traders and entrepreneurs can benefit from Cyprus's non-domicile regime to optimize their tax position. My name is Dan Sampaio and I'm joined by the wonderful Charles Savva to take us through today's discussion. Charles Savva is the founding and managing director of Savva and Associates. With over 22 years of experience in the Cyprus professional services space, Charles' areas of expertise include Cypriot tax, international tax planning, and investments immigration. Since founding Savva and Associates in 2009, Charles has advised extensively in the areas of tax optimization and assisted high net worth individuals and their families obtain EU citizenship or permanent residency via investment programs. But before we begin today's webinar, a quick housekeeping item. You are able to submit questions to our panel by typing them into the questions pane of the toolbar on the right-hand side of your page. And Charles will endeavour to answer as many of those questions as possible during our Q&A session. And we do encourage you to get those questions in. It's now my pleasure to hand you over to Charles to begin. Thank you.
Hello to everyone from all corners of the world, wherever we find you. I'm based in Nicosia, Cyprus. We are a Cyprus-based professional services firm. Let me just turn off my emails. My apologies for that. So we're based in the capital of Cyprus, in Nicosia, and we've been in business since 2009. Specializing in international tax optimization. And one of the areas that's kept us quite busy the last couple of years is assisting crypto investors, crypto founders in many cases, including technical development teams with the subject of taxation and meeting global tax reporting obligations, as well as, of course, optimizing taxes insofar as possible. So that's the general topic of our webinar today, and I hope you all find it to be interesting and informative. Just very briefly about who we are in our background. We are basically a collection of ex-Big Four chartered accountants with significant Big Four experience. Most of our management staff have 10 plus years experience in Big Four before joining us, and lawyers from some of the largest, most well-known, most reputable law firms in Cyprus. We're actually three firms cooperating under one roof, servicing the same clients. We're a tax advisory and fiduciary firm. We have a preferred legal partner and also a preferred audit partner as well. So we cover all of the spectrum of professional services that most clients require who set up Cypriot structures for various different business purposes. We can just go to the next slide. So the brief agenda for today is to cover the so-called Cyprus Non-Domicile Regime, which is basically a special personal tax regime that we have in Cyprus, similar to what the UK had up until this year before phasing out their non-dom program, similar to what Portugal had with their famous non-habitual tax resident program. And we'll walk you through the specific details of how this program works, the prerequisite requirements to qualify, and what it means to be a Cyprus non-domicile tax resident. We'll then look at some structuring opportunities and case studies involving crypto investments, not not exclusively using Cyprus, but also using foreign jurisdictions like the UAE, like Hong Kong, just as an example. Then we'll look at a few case studies and see a more practical application of the technical points that we'll be covering during this webinar. And then we can close off with a Q&A session. Okay, next. So as many of you probably know already, there's countries, particularly in the western part of the world, that have taken initiative and introduced crypto-specific tax regimes. But for a large part of the world, that remains absent, meaning that while crypto gains are still taxable, there are no special provisions in the tax law of many countries, including Cyprus at present, that address specifically this unique and new asset class that we call cryptocurrency. And we give a couple of examples here of major countries like the US, Germany, UK, and India, and how they approach the taxation of crypto investments. So the American IRS, for example, treats crypto as property, meaning that every sale, trade, or crypto to crypto swap, for that matter, is considered a taxable event. And we'll see a bit later on in our presentation, there's also some very onerous reporting obligations, line by line transaction reporting obligations in the US and also some other jurisdictions as well. Germany, we have a lot of clients that are German nationals that have invested in crypto, especially Bitcoin, back in the early days. So we've got quite a bit of experience dealing with the German tax aspects of crypto investment, and I can characterize the environment there as being very misunderstood, the tax environment. So while there is a general rule that long-term holding over a year is exempt, that's not the case with many other aspects of crypto investing, like DeFi, like staking, and then you would need to specifically look at how those, for example, staking profits are taxed under German tax law. And many of the exemptions for long-term holding do not apply, staking being one of the primary examples. I don't want to get too into the foreign tax aspects of cryptocurrency investments, because we are a Cyprus-based professional service provider. We are competent and experts in Cyprus taxation, but as part of our work as when we have our international tax advisor hat on, we work with local experts, people like many of you joining this webinar today who are local experts in your respective countries, to help a specific client optimize their overall structure, whether that be crypto investments or holding in specific businesses, whatever the case may be. Okay, we can go next. So just again here briefly, I want to give some background to you all as to the regulatory backdrop that we face today. So we have this regime called, in short, CARF. It's the Crypto Asset Reporting Framework. It's an OECD framework. as well as the EU's DAC 8 directive being the two most relevant developments that we have that we're dealing with that relate directly to cryptocurrency investments. As tax transparency increases, it should come as no surprise to anyone that the ability to hold assets offshore anonymously is very quickly diminishing. In fact, we now have a general timetable that by I believe it'll be the end of 2027, which is just around the corner. There will be automatic reporting of crypto transactions, obviously from exchanges, to tax authorities, similar to what we have seen for many years now with the banks automatically exchanging information with tax authorities over the world. There's, I think, over 120 countries that have signed these multilateral agreements for the exchange of information between banks. So as this trend now permeates into cryptocurrency investment, we're seeing a lot more clients surface and say, look, I want to get in line with my reporting obligations. I want to start thinking about tax optimization. What are my options? How can I optimize and minimize my taxation from my cryptocurrency investment activities? It's investors need to identify at the end of the day tax efficient jurisdictions that provide both legal and structured solutions for cryptocurrency taxation, which is what brings us to Cyprus and our presentation today. Next. Go to the next slide. Okay. So as we've already touched upon very briefly, many of the leading economies in the world have should come to no surprise, are high tax jurisdictions. India, 30%. UK can go up to 45%. Germany, 45%. I'm Canadian by background. Cryptocurrency transactions can be taxed up to 50%, depending on whether they're held personally or through a corporate entity. And again, as we mentioned very briefly earlier, there's US form, it's called Form 8949, requires a very meticulous line-by-line recording for every crypto transaction. And for many of you that are involved in the practicalities of crypto investment, you then understand that that's not always very easy to do from a practical sense. However, it remains a reporting requirement, a tax reporting requirement if you are a US national. And as tax advisors, we always advise our clients in the strongest terms to always be in line with their statutory reporting obligations. Unrealized income taxation, very big problem with crypto. So some jurisdictions tax staking rewards, Germany being one of them, airdrops or governance tokens distributions immediately upon receipt, which creates an issue, essentially a cash flow issue, which is a real problem that needs to be addressed by taxpayers. And until these countries develop and introduce crypto-specific tax legislations that acknowledge the uniqueness of this new asset class, these problems are going to persist. Some countries like India impose a 1%, it's called TDS on every transaction. again, complicating even the most routine wallet transfers. Let's go to the next slide. We don't really need to say anything more here. The two major regulatory frameworks, as we said, are CARF and DAC 8, especially if you're a professional in the EU. And a lot of what we're discussing today, the backdrop comes from these two major developments. Let's, I think, move on to the next slide. Okay, so this is just a very brief overview here of the Cyprus taxation regime. Cyprus has been a leading financial center since the very early 90s. The non-domicile scheme was introduced back in 2015, shortly after the world famous Citizenship by Investment program was launched in 2013. And the reason our government introduced the non-domicile program was to give an incentive to all of these high net worth individuals and their families who had acquired Cypriot citizenship by investment to actually consider relocation to Cyprus on the merits and on the basis of this very attractive personal tax regime called the non-domicile. Many international tax advisors that I speak to on an almost daily basis today will agree that the Cyprus non-dom is by far the most attractive personal tax regime within the EU, and it's among the most competitive in the entire world. And I will also add, it's also probably the world's most simplest non-domicile program, because I can explain it to most clients in under 2 minutes. And we'll cover that in one of the upcoming slides shortly. A staple of our tax regime is our 12.5% corporate income tax rate, which compares quite favorably to some other EU jurisdictions. Germany, France, Italy. As I mentioned, our non-domicile program should be understood as the most attractive non-personal tax regime in all of the EU. And its tax holiday period is 17 years, which is the most generous non-dom period, tax holiday period I've ever encountered in any non-domicile program that I've seen as a tax advisor. We have no wealth or inheritance taxes in Cyprus. We are, of course, a full EU member since 2004. We are a Eurozone member since 2008. And we have a very, very wide network of double tax treaties to ensure no double taxation, which proves to be very, very important in the projects that we undertake, where our clients are relocating to Cyprus and transferring their personal tax residency to Cyprus, especially if it is a non-EU national. There are some challenges as well. Banking for crypto remains a big challenge for Cyprus, and we'll discuss this in some more detail and give you some more backdrop on this shortly. There's also some, I'll call it uncertainty in regards to future developments in terms of crypto-specific taxation. However, that uncertainty we will show you in our presentation here can also result to a very favorable tax regime being in place here in Cyprus. So there's been formal media reports, although lack of any concrete statements from our government, but we know that as early as this year, there will be a crypto-specific tax regime being introduced in Cyprus, and we have some of the basic details that we can share with you today. Let's move on to the next slide. Okay. So under our non-domicile program, the major requirement, there's two major requirements, okay? One is you either take the quote unquote normal route, which is staying in Cyprus for at least 184 days, meaning you basically live here for at least half of the year. If you are able to do that, then you can immediately qualify and have us register you with our tax authorities as a non-domicile personal tax resident and issue you a tax identification number. But we have this second route to qualifying, which is called the 60-day rule, okay? And as the name implies, you can qualify as a non-dom by staying as little as 60 days in Cyprus. However, if you choose this route, then you must commit to not living in any other one country in that same calendar year for more than 184 days in that calendar year. Okay, so you can be a non-dom having stayed only 2 months in Cyprus during the tax year, but you cannot stay more than 6 months in any other one country in that same calendar year. So in theory, you would be in Cyprus 2 months, you'd be up to 6 months in obviously a country that's important to you, where you have some connections to, which would theoretically be the reason you want to stay there for up to 6 months. That gives us 8 months, and then you'd have to choose where you live for those other 4 months out of the year. Obviously, you can stay in Cyprus more than the 60 days. The 60 days is a minimum, but it is a hard requirement that you do not stay in any other country other than Cyprus for more than 6 months in that calendar year. That is the 60-day rule, and that is one of the cornerstones of why our non-domicile program is considered so attractive. Because in theory and in practice, you can qualify under this program without actually relocating to Cyprus. I would not consider living in Cyprus for 2 months to qualify as a relocation per se. Most, if not all, other non-domicile programs worldwide require you to actually live in that country. Okay. Let's go to the next slide. So the regime's flexibility is one of its main strengths, but its reliance on residency tests, where you actually live, not living more than 6 months in any other one country, obviously invites some scrutiny from our clients' home countries. Okay, and if you're a US tax advisor, you should immediately be thinking about US CFC rules. If you're a German tax advisor or client, you should immediately be thinking about Germany's exit taxes, etc., etc. However, you've probably ascertained by now that a digital nomad is ideal for this type of regime, and it's attracted a lot of crypto investors and so-called digital nomads, because it really is in line with their lifestyle and their global movements and where they live, and not being particularly tied down to any one country anywhere in the world. So at the end of the day, the non-domicile status is accessible with strategic planning, and we feel and we've seen in practice that it's ideal for crypto investors willing to invest, of course, some of their time and resources in Cyprus, specifically the residency resources that are required. You need to commit to 60 days or at least 184 days. Okay. Once you qualify, then as I've already stated, you have a 17-year tax holiday on basically three sources of income. Okay. And these are the most common sources of income for most high net worth individuals. It's your worldwide dividends, it's your worldwide interest, and profits on the disposal of securities as defined by Cyprus tax law. Securities, in short, are basically stocks in private or public companies and bonds. Okay. In fact, all Cyprus tax residents, even domiciled Cyprus personal tax residents, have a full exemption from tax on profits from the disposal of securities. It's not unique to non-domiciles, but I'm trying to demonstrate that for 17 years, you don't, as a non-domicile, you don't have to think about tax on these three forms of income. And again, most high net worth individuals around the world, these are their primary, their only three sources of income. So obviously that compares quite favorably to places like the UK, for example, especially now with the absence of their non-domicile program. A lot of our clients, whether they're involved in cryptocurrency investment or not, in the last year to year and a half, have been UK non-domicile clients that have planned for their transition out of the UK as a result of that program being phased out. Let's go to the next slide. So we know, based on rumors and whispers, one of the good things about living in Cyprus is it's a small island of about 1 million people. It's actually less on the government-controlled side, so nothing is kept secret, especially in government, and especially when it involves introduction of new taxation. So we know there is a crypto specific tax regime on the horizon. We know that what is being discussed is approximately a fixed 8 to 9% crypto taxation. And we also know that there are discussions to roll this out this year. It would probably be closer to the end of the year if they're able to do that on time. We don't have details, and those details have not been agreed in any way, shape, or form. So we're not sure if 8 to 9% applies to personal taxation or corporate taxation or both, for example. We don't have the micro details on things like staking and DeFi, but the general discussion that is happening now appears to be focused and centered around a fixed taxation somewhere around 8 to 9%, which would make Cyprus a very attractive EU jurisdiction for taxation of crypto. Overall, we do not have low personal tax rates in Cyprus. As you can see from the table here, our top rate of 35% for income in excess of 60,000. I mean, in no way, shape, or form should be considered low taxation. So it's important to understand from our clients how they've structured their crypto investment. Are they holding it personally? Are they holding it through a corporate or offshore entity? That's usually our starting point when we advise a client. So irrespective of whether you're a non-domicile or not, if you're a personal tax resident in Cyprus, holding cryptocurrency and being an investor and holding those assets directly as an individual, you are not looking at a favorable tax position. But through the use of Cyprus or foreign corporate entity, we can obviously dramatically decrease these tax rates to clearly 12.5% if you're using a Cyprus company today, and even 0% if you're using a foreign entity. And we'll see some examples very shortly. Let's go to the next slide. Okay, this is probably the most important slide in the presentation. You may want to put an asterisk here. There are, unfortunately, too many YouTube and social media videos circulating for years now, purporting Cyprus to be a tax-free jurisdiction for the holding of crypto investments, specifically personally. That's just simply not true. And it's a very dangerous statement to make towards a client, because it will be at best misleading, and at worst it will directly result in massive tax liability, including criminal liability for non-declaration of cryptocurrency gains. What do I mean specifically now? Once you start seeing what these videos and these tax advisors, I put it in inverted commas, are trying to say, is that, well, if you hold on to the crypto long enough, never defining what long enough means, well, then the Cyprus tax authorities consider that to be capital gain in nature. And we know that capital gains in nature, capital gains taxes, has a very, very finite scope. It only applies to immovable property situated in Cyprus. Along with the Big Four, who certainly have the most experience in this area in Cyprus, we're one of the very few non-Big Four firms that actually have experience in preparing and submitting tax rulings on this matter. The reality and the real picture is that the Cypriot tax authorities will give you maximum one exemption for long-term holding, which throughout, even with our experience, we cannot reliably define that as at least 1 year holding or at least 2 year holdings. But it's somewhere in that area. Your first liquidation of cryptocurrency gains after holding for that, let's call it 1-2 year period, you can in fact prepare a ruling, and as we've done for many of our clients, and get most likely a positive reply that profit will be exempt from Cypriot taxation. Beyond that, though, they will not give you another exemption on cryptocurrency liquidation, irrespective how long you hold it. Because once you've liquidated more than once, then you're a trader in the eyes of the Cyprus tax authorities. This is based on our most current discussions, current engagements with the Cypriot tax authorities on this matter. So extremely important we understand that by no way, shape, or form are long-term cryptocurrency holdings exempt from taxation in Cyprus. And anyone who purports differently is simply trying to sell you some very dangerous, um, completely incorrect advice. Um, okay, so again, important, just some regulatory backdrop to combine here. It's important to understand that the EU's MiCA regulations, which came into effect last year, focus on market rules, not tax. So we know countries like Cyprus have room to maneuver in terms of what tax specific legislation is going to be introduced. The EU does not regulate at an EU-wide level taxation. Taxation is up to each and every country individual. Of course, your tax systems framework needs to be approved, but that's done usually on your accession into the EU. And for Cyprus, that was done back in 2004. Let's go to the next slide. Okay. Again, not too much more here to say. I think we've covered it. Corporate Cypriot corporate structures are subject to corporate income tax of 12.5%, while personal holdings, the taxation, as you can see, beyond 60,000 euros of profit, go up to 35%, which again is not a low rate of taxation. Let's go to the next slide. And this is where once we have our planning hats on and we're focused on tax optimization and minimizing global taxes, this is where we begin to look at other jurisdictions as well. The UAE was, up until last year, it was kind of a no-brainer when it came to tax planning for crypto investment for a number of reasons. Okay, number one was obviously because there was no corporate taxation up until last year in the UAE. But the second reason, and just as importantly, was that the UAE as a jurisdiction is easy to establish real economic substance. You can have real directors that have a very relevant background to crypto investment, serving on your board and have real economic substance, as opposed to trying to achieve these types of things in a place like the Seychelles or the BVI or these other common offshore jurisdictions who also have zero corporate income tax, but good luck finding a suitable board of directors. Good luck trying to set up real economic substance so that you can prove that these companies are actually managed and controlled in those countries and hence corporate tax residents of those countries. Okay, so and that's the simple reason we don't really use, or we haven't in many years now used these old typical offshore jurisdictions like the BVI and Seychelles for purely tax planning purposes. They serve a very useful purpose for things like asset protection and corporate structuring, but very rarely do they serve a useful purpose, at least for legitimate international tax planning. So this and the previous slide here describe a scenario where you are a crypto investor operating through a UAE company. And while the UAE has introduced a 9% corporate income tax rate, it has given a couple of small exemptions called qualifying activities. And the long-term, more than 1 year holding of crypto is one of those qualifying activities, which results in an exemption from their 9% corporate income tax. So as a non-domicile tax resident in Cyprus, you can receive a dividend from your crypto investing company in the UAE, and that dividend would be tax-free in Cyprus on your personal income tax return, and it would also be tax exempt in the UAE under the corporate income tax return of that country. This is one of and again, I don't want to say the word common structures that we use, because there is no one size fits all, especially when it comes to international tax planning. But this sort of structure is I think allows you to understand how a potentially zero tax solution can exist for clients basically from any jurisdiction in the world. Let's move on. We mentioned earlier, banking is one of the issues we're currently experiencing in Cyprus, and I think it's the case in most European countries also within the EU. The Cypriot banks here have taken a very draconian position when it comes to accepting clients, even local clients that have completely other businesses. Their main businesses have nothing to do with crypto investment. Once you start introducing some cryptocurrency investment related income coming into those banks, you're going to get yourself in trouble. And that position applies even for locals here. We're seeing the very first signs of that being relaxed just now in Cyprus, but I think we're still a ways away from the banks here being open to crypto as an acceptable form of business. That said, there's no rule or law in place that requires you to do banking as a cryptocurrency investor with your personal tax domicile in Cyprus, or even a cryptocurrency business operating here under a regulated umbrella. So there are options, there are solutions to this issue, but banking is one of the main issues that we experience, and I don't think that's going to change in the immediate term. Next slide. Okay, so just a very quick case study here. We have a UK investor with 500,000 sterling in crypto assets, relocates to Cyprus, secures their non-domicile status under the 60-day rule. So they will be here for 2 months out of the year. Sells their Bitcoin on the Coinbase exchange for 2 million in 2025, the current year. The gains, if considered long term, as I flagged in that important slide, would be potentially and likely tax-free in Cyprus, which is a big difference from what the prevailing UK tax would be in the same situation. And this scenario obviously is one where the crypto assets are held personally by this individual. Okay. This next scenario sees a US trader set up a company in Cyprus, a Cyprus corporate vehicle, and trades 1 million in crypto profits annually. Obviously pays 12.5% corporate tax, with the resulting net gain, again, versus the prevailing US tax position. Actually, I think the next slide will make the point a little more clear. We look at the next slide here. Yeah, perfect. We have to address now just a couple of the main pitfalls, the main misunderstandings that prevail. The main one is spending spending more than half the year once you have chosen the 60-day route, spending more than half the year somewhere else. How do you prove where you are? Well, the answer is actually very simple. You prove it with boarding passes. It might sound a bit funny, but that is what a tax authority, if you're ever investigated, is going to look at as prime proof of where you've actually been. So show your boarding passes where you've been. And of course, ensure you don't spend more than half that year in Germany, in our example. Because in that case, sure, you're registered as a Cyprus non-domicile, you're registered as a Cyprus tax resident, but Germany considers you to be tax resident as well. Fortunately, we have a double tax treaty, plus we are fellow EU members. So in theory, double taxation is not possible, but it's a disastrous scenario when our non-dom clients come and tell us, usually a year later, that guess what? Last year, I spent 7 months in Germany. I was 9 months in Italy. We had a big problem with our business, and so it's the number one error and mistake that we see, and it needs to be avoided at all possible costs. Substance gaps we list as the second big area, pitfall and risk. And that's not just applicable to a Cyprus company. That's also applicable to our example of a Dubai free zone company. To state to your home country's tax authority, if you're ever investigated, that me as a shareholder, as a 100% shareholder in this UAE free zone company, that this company is managed and controlled there, and it's a tax resident in the UAE, well, you need to prove that. And it's proven by number one, most important, is where the management board sits and what decisions they've taken and how have you documented those decisions. For example, here, the investment decisions of this cryptocurrency asset company. And then second, the substance. Do you have an office? Do you have employees? What business infrastructure do you have in the UAE? And the UAE is the best quote unquote offshore jurisdiction for putting you in the best position possible to have a successful outcome in those two areas, substance and having proper management and control. So just by way of a conclusion here, the Cyprus non-domicile regime, as we have shown, offers a zero taxes for 17 years on dividends, interest, and the disposal of securities. And Cyprus is a full EU member, offering EU stability and no absence of competent tax advisors, despite my warnings on some tax advisors putting out videos and social media content that's very misleading. There's also no shortage of good, qualified, competent tax advisors. All of the big four offices here in Cyprus are present here in Cyprus as well. So there's a good community of professional service providers that can help you navigate the complexities in the correct way. We have the uncertainty but slash opportunity that comes with this new crypto-specific tax regime that we're expecting as early as the end of this year, with an 8 to 9% flat tax being discussed at present. So these are I think the main summary points that I would highlight. Next slide. So a flat 8 to 9% tax, if applied to individuals, would be absolutely great. It would put us in line with one of the most attractive countries in not just the EU, in the world, in terms of crypto taxation from a personal point of view. And obviously 8 and 9% flat tax from a corporate tax point of view would also be an improvement from the 12.5% corporate income tax that we have at present, and being discussed that it might be at some point, I believe it will be increased to 15%. Okay. Next. This is just for anyone's future reference, if they want to know what are some of the main areas that of services we provide. They could obviously you could look at our website, but this is a short list specific to the subject area that we've been discussing today. As I said at the beginning of this presentation, in essence, we are a group of ex-Big Four chartered accountants, mostly with tax backgrounds, and lawyers from some of the largest law firms in Cyprus, all working in the same office building, serving the same clients. That's it. I didn't want to burden or bore you too much with a long presentation. If you have any questions, myself and two of our managers, Mina and Maki, are at your disposal now to answer any questions. Mina, I've seen my eyes caught a couple of questions that came in during the presentation. Do we have?
Yes, we have some questions that we received from. So the first question is, how do tax authorities monitor, verify the number of days within Cyprus and other countries with regards to the 183 days or the 60-day rule? I understand that Charles has already answered this during the presentation when he mentioned about the boarding passes. Actually, how it's done, we keep a record, or the person, tax resident per individual is keeping a record of when it comes in Cyprus, out of Cyprus, and in and out of any other country, and keeps the boarding passes. And this is submitted to the tax authorities upon request for evidencing that it stayed 60 days or 183 days in Cyprus.
If our client is an individual who we've assisted with personal tax registration, then we hold a personal residency file on their behalf. I know it sounds cumbersome, but we give instructions to our client or their secretaries or their assistants to send us their boarding passes. We're not trying to be overbearing and monitor all the movements of our clients, but it's going to be a good idea to have a residency file being put together in real time and not being investigated, for example, audited 3, 4, 5 years down the road. And the tax authorities say, okay, in the year 2021, prove to me you were here 60 days or 184 days. And then you're scrambling, and of course you won't find. So one very important thing we advise clients to do, and then upon their agreement, we overtake it, is to hold a personal tax residency file, which basically is just a log of their physical movements.
Okay, the second question we have is we don't want to spend 60 days, but need Schengen for self and staff. Is this a possibility? No, this is not a possibility. Up to now, Cyprus is not part of Schengen, and in any case, we are trying to get in, but we are not.
There was a, sorry to cut you off, Mina. 1 month ago or 6 weeks ago, there was formal media release by the EU and by the Cypriot government. We are entering, well, there's only 2 countries left. It's us and Ireland, and we're entering Schengen officially at the beginning of 2026. So beginning of 2026, Cyprus will be a full Schengen member.
Okay.
It was an important development and one that we've been hearing about for over 10 years now.
The next question is there any exit tax on unrealized crypto gains for cryptos held in personal wallets, i.e. not corporate assets? And what this question means, there's a follow-up. I mean exit from Cyprus after having been Cypriot tax resident, non-dom for at least 1 year.
Basically, there is no tax. There is no exit tax on that. There's no exit taxes for any unrealized.
There's a few issues that would best be discussed directly. You feel free to reach out to us. There's some important issues that need to be defined that will make relevant or non-relevant certain aspects of that exit tax.
Next question is, which country's substance rules apply if you are a Cypriot resident with a Dubai company? Is it the substance rules of Dubai or Cyprus that applies?
If there's a double tax treaty, like there is in the case of Cyprus and the UAE, and I would never advise a client that is tax resident in Cyprus to have a non-double tax treaty company or ownership of it, and with over 60, I think 66 double tax treaties, not a case we usually encounter. So it would be the double tax treaty that defines corporate residency, but then there is thousands and thousands of pages of best practices, international best practices that define it. So the short answer, I would say, you could look at Cypriot. In the case of the UAE, you would look at the double tax treaty, but in practice, you would look at how the Cyprus tax authorities define corporate residency and how it's evidenced. And it's in the 2 ways that I've discussed during our presentation. The primary way is evidencing the management and control of the company, and then second is substance. You can have all the substance in the world. If you cannot prove that management decisions were taken in that country by people in that country, then all the substance in the world is just a big waste of money.
The next question is the non-dom available for all assets or for all incomes? Have you seen people moving from an estate planning perspective? As you have mentioned before,
there's no requirement to analyze or prerequisite on what your assets are or what your sources of income are. Anyone qualifies as a non-domicile. However, the tax exemptions only apply to those 3 sources of income that we talked about: worldwide dividends, worldwide interest, and worldwide gains on the disposal of securities.
Okay, we received some questions. It is from the Residency by investment program. Would applicants be able to make investments through crypto?
not to purchase property, no. The funds that purchase the property, if you take the property investment route, which almost everyone does, but there is other ways to acquire residency under the so-called Golden Visa program. There's other investment options, but if it's through property, you must show that the funds came from abroad, from a bank. It cannot be through crypto, unfortunately. But if I can add to that, there's pretty simple solutions to that.
Excellent. Thank you for that, Charles, and my apologies for jumping in to what was shaping up to be a fascinating rest of that Q&A, but it looks like we're just out of time today, but I think we've answered quite a few questions, which has been great, so thank you very much for sending those questions in. Before we wrap up today, I would like to say a massive thank you to Charles for your insights, for your thoughts today, and of course to Mina and Makis as well for helping out at the Q&A session. Contact information in front of you now. Please do get in touch if you have an inquiry or anything that you want to run by Savva and Associates. We do encourage you to get in touch. Thank you also to our audience for being with us. We greatly appreciate your presence today. So once again, thank you to our wonderful speakers, our excellent panel. We hope to see you again soon, and I hope everybody has a lovely rest of your day. Thank you and goodbye.
Thank you very much.